Well, first of all, thank you very much for coming to today's session on China's bond market. I'm Casey Kwok, and let me welcome all of you to Asia Global Institute. I'm sorry that some of you may feel squeezed a little bit. This event was very quickly overbooked, reflecting the very high level of popularity of our speakers as well as the subject. So next time if AGI organizes anything, register very early. Otherwise, just like some of the people who will be disappointed because we closed the registration window very quickly after we started advertising for this event. But the subject we have today is a very timely subject. If you pay attention to the news, you hear about China's bond market every once in a while in the recent past. I just want to say a few words to set the macro background, and then I'll leave it to the speakers to describe in more detail what they have done. We all know that China has reformed and opened up for the last 4 decades, and this has transformed the country totally. It has also integrated China's economy into the rest of the world, and in the last 2 decades, China actually made world history. I mean, it changed world history. But so far, the liberalization and opening up of China's economy is primarily, I would say, in goods production, in goods trade, but not very much in services. Of course, China is now moving on to the liberalization of services more aggressively, and the financial market reform is becoming an increasingly important subject in China's next stage of reform. And well, financial services, of course, is not just the buying and selling of financial products and financial services. From a macroeconomic angle, financial services, a well-functioning and efficient financial market actually helps to promote efficient allocation of resources and also helps to distribute and manage risks a lot more effectively. Within a country, it is like this. Globally, if China is able to integrate its financial markets better with the rest of the world, it means a global reallocation of resources. It also means a global reallocation and management of risks. So this is potentially, from a macro angle, a very important subject. Of course, China being so big, we also need to bear in mind that as China continues to liberalize its financial markets, it is not just the capital flowing in and out of China, it will also have very substantial impact on the rest of the world because the amount of money involved is going to be huge. We have already seen how sentiments towards capital flows into or out of China have already affected the sentiments in many emerging markets, for example. So this is a very big and long-term subject. Today, we are very happy to have Alfred and Sally from the IMF to come to talk with us about this very important subject. They have written, they are co-authors of a book recently or to be published by the IMF. I'll leave Sally and Alfred to give you more details about what they have done and what they have prepared for you. And then after their presentation, we are very happy to have Professor Tang from the Faculty of Finance in the University of Hong Kong to help us to lead the Q&A discussions. Without any further ado, let's give a big hand to our speakers. Thank you.
Thank you very much. It's a real pleasure to be here. I have to admit, this is my first time at the University of Hong Kong, so I hope this is the start of maybe more regular visits. What I wanted to do is, before I get started, let me first highlight that this book is a collaborative effort. A number of authors from different departments at the IMF, but also almost all of the key regulatory agencies in China were involved in the exercise. Some of them authored or co-authored some of the chapters. That includes the central bank, the PBC, the securities regulator, the Ministry of Finance, the NDRC, the China Deposit and Clearing System. So again, it was a collaborative effort. We have a few academics and also some people that are in the market. Because if you tackle an issue like this, what you want to have is three things. First, you want to do rigorous analysis, of course. But when you talk about a bond market, you also want to get the institutional detail right. And unless you do it with people who are actually involved in the market, you might make a mistake. And then, of course, coming from the IMF, in terms of thinking about the way forward, which is a little bit the title of the book, it is also useful to once in a while think about the international experience of other countries. So what I'll do is I'll kind of set the stage and then talk a little bit about the government bond market. And then Sally will cover the credit market and some of the unique characteristics, including on liquidity, and finishes up by giving some thoughts on reforms and our final takeaways. So if you're ready, let's go. So I'd like to come back to this issue that China last year celebrated its 40th anniversary of reform and opening up. And I think that period can be identified to have three major effects. First of all, it was a period where China integrated its trade globally. Secondly, as highlighted correctly, it was product integration. And of course, the result was the growth miracle that we have seen in terms of economic growth of 10% on average over 4 decades. Now, when it comes to the financial system grew not only as much as the real economy, but it actually grew even faster. So today, China's financial system is not only large, it has the largest banks in the world, it has the second largest equity market, and the bond market, which is the topic of our discussion today, is the third largest in the world. But despite the fact that China's financial system is so large, there are two phenomena that I think are worthwhile highlighting. What are they? The first is, if you look at the structure of China's financial system today, despite its size and level of development, it is basically a bank-based financial system. And the way to see that is, this is sort of like the financing of companies in China. The part that is being financed through bond financing, 10%, is very, very small. And you can put that into any international context for countries that have financial systems as developed as China. The second one is that, again, despite China's global footprint, trade integration, increasingly also investments abroad, China's financial system up until now has not been integrated. It's still relatively closed. And with the exception of bank financing, where banks are financing some countries in Asia and Africa, foreign participation within China is very small. Now, what do we mean by small? Of course, you could think about, what's the share of foreign bond holdings in the United States? But then you would probably say, well, the United States is not the right reference point, correct? But then you can use a few other ones, and I think the one that kind of brings the message home the most is when you look at India. I think we all know that India's financial system is globally not integrated, correct? But even compared to India, China's integration is even less. So less than 2% of the outstanding stock of bonds are held by foreigners. By the way, this is also true for the equity market. So it doesn't matter whether you're looking at the equity market or the bond market. Now, why do I say that? Well, it's a little bit related to the topic of the title of the book. What's the future of China's bond market? I don't think you have to be Einstein to predict two things. First of all, that the structure of China's financial system is likely going to change, meaning that the share of capital markets, and in particular bond markets, will probably be larger over the next couple of years. The second one is that it is probably also not surprising to predict that most likely the share of foreign holdings of Chinese bonds will increase over the next couple of years. So in a certain kind of way, that's good news. Let me add to that another dimension that kind of brings the message home when we think about the future of China's bond market. This map here is from a paper that is actually available online by two of our colleagues, Tovar and Noor, that asked the following question. They said, all right, you know, how important is the RMB globally? Some people think of it as RMB internationalization. And what they said is, okay, one way to look at it is to see how different currencies in other parts of the world are co-moving with the major currency blocks. Of course, everybody knows blue here is the US dollar, green is the euro, and red is the RMB. And again, interestingly enough, you know, despite the fact that China's financial system is not that integrated, it seems to be that a lot of countries' currency co-move with the RMB. Now, what that suggests is that we are probably moving toward what we call a tripolar international monetary system, where one of the major currency blocks is the RMB. Now, if that is true, and let's suppose you're sitting in one of those countries where your currency moves a lot with the RMB, it makes perfect sense for official reserve managers at central banks, or even sovereign wealth funds, or even the private sector to hold a part of their reserves and the management of reserves in RMB. We already know that a number of countries have targets of RMB reserve holdings. One that is very well known is the RBA in Australia, 5%. But in 2017, the ECB, the European Central Bank, also came up with a target of 2%. And that, of course, is sort of like the beginning, and you will probably see more of that happening over time. And of course, when there's more demand for RMB reserves, that means there's more demand for RMB bonds. So the next question then is, when you think about the future of China's bond market, what does it depend on? And I think it's fair to say it depends on two things. One is policies, and the other one is by private and official actors, correct? So when it comes to policies, I think we have some very clear statements. First, last year in April, and since then, President Xi has highlighted that China will continue to open up its financial system. Secondly, Premier Li Keqiang has articulated on numerous occasions, most recently in March at the work report of the government's work report, that the bond market is meant to open up further, and that the bond market ought to be playing a more important role within the financial system. So I think the direction from the policy side is very clear. This has also been articulated more recently by the governor of the central bank, who echoed these policy statements. Now, when it comes to the private sector, I think the inclusion of RMB, government bonds, and policy bank bonds as of April 1st this year in the global Bloomberg Barclays Index highlights the interest by the private sector, and it would not be surprising if some of the other major indices over the next year or so would also look at including the RMB bonds in their indices. So maybe to be a little provocative, one could argue that we're almost at a, let's call it a paradigm change, where the last decades have all been about China's trade integration, product integration. Maybe the next decade will all be about China's financial sector integration. And as you can imagine, that will bring many benefits. One of them could be the provision of safe assets to the rest of the world. It allows foreigners to diversify their portfolios. That's all very good. But of course, these also come with challenges, correct? It needs to be managed carefully to minimize risks and to maximize the benefits. So if you looked at the structure of China's bond market today, what would it look like and what are some of the key characteristics? So this is the whole universe of China's bonds outstanding. What you see here is anything reddish is basically the government or quasi-government. When we talk about quasi-government, we include the policy banks there. And what you can see is that 60% of the market is dominated by the government. That is not surprising, quite common for countries in the developmental stages of their financial system. What is a little bit surprising, and for those of us who come from outside of China and spend a little bit of time there, is how quickly things change. So the joke that I usually make is you go on vacation for a few weeks, you come back, and sure enough, there is a new segment of the financial system that you didn't even know about. By the way, the regulators were also on vacation. When they come back, they find out that there is a new system. Now, which one is one of them? The local government bond market. The local government bond market today is the largest segment. It is even bigger than the government bond market. And it basically happened overnight. Since 2015, through a swap program, and then the government, of course, allowed local governments legally to borrow, as they called it at the time, open the front door and close the back door. We are not so sure whether all the other doors are closed, but the front door is definitely open. So the other one, which is very unique to China, is when start out with the part that is not unique. China's bond market now has the whole suite of products. So it is a very developed market. It has, when it comes to the government bond market, instruments that range from 3 months to 30 years. Yes, 50 years. 3 months to 50 years. So the whole range of instruments is available. But what is unique about China is especially the part that has to do with companies, which we call the credit market or the credit bonds. Why is it unique? Because there is not just one market, there are effectively 3 different segments. Why is that? And they all have different names. They're all regulated by different regulatory agencies, and they all have different rules. Now, the reason why that is the first corporate bond or company bond was issued in 1983. So the bond market is not really that old yet. It's a relatively new market. In 1983, and which company issued the first bond? It was, of course, a state-owned enterprise that needed financing. Who regulates the state-owned enterprises? The NDRC is the one that is in charge. So the NDRC is the one that facilitates the issuing of the first bond by a company. Then after some years, of course, there was the question, well, how about the private sector? They should be able to borrow. And the securities regulator, the CSRC, created another market. It has a different name, but it's the same thing. It's a credit bond market, it's a company bond market. It just happens to have a different name. It's called the corporate bond market. And it also has similar instruments, but it's regulated by the CSRC. And it turned out that at the time when the CSRC was developing the corporate bond market, it wasn't really so interested in the bond market. What was it interested in? The equity market. It actually put more resources and attention to developing the equity market. Now then some said, including the central bank, but we need a liquid bond market. We want to help develop the market. And then the PBC said, we're going to establish a bond market. Now the term bond is not included. It's called the market for medium and short-term notes, because if the word bonds were included, then the regulator would be the CSRC. So it is just a confusion, but in the end, they're all the same thing. These are regular bonds, have similar maturities. However, they are regulated by different agencies. So the market that I'm just describing, the market for medium terms, is regulated by an affiliate of the PBC, which is NAFME. Now, why do I highlight that? I highlight that because we can explain why China today has 3 corporate bond markets. As a matter of fact, the most important one, the largest one, is the interbank bond market. But if you're thinking of a well-developed market, maybe today is the time, and we'll come back to that, to think about whether the segmentation makes sense or whether the segmentation creates risks. Because what do you think companies do when they look at where to issue the bonds? We call it regulatory arbitrage. Right? You go where the regulation is the least onerous. Now, what are some of the other characteristics of the market? Now, coming back to the credit bond market, the company market, it's the ratings. And here we're just comparing China, red, to the United States. So in China, basically every bond is rated AA or higher. As a matter of fact, 95% of all bonds outstanding have a rating of AA and higher. How does it compare to the United States? These are only 6%. So for the same rating, only 6% of the companies in the US have a rating of AA and higher. Now, why is that? Regulation, among others. So in China, effectively, you cannot issue a bond unless it has AA rating. Now, that might then cause companies to seek guarantees to ensure that they get the better rating. But there are 2 things I think one needs to keep in mind. One is, when you look at the quality of companies under each rating, and you compare the quality of the companies in the US under each rating, there's a lot more dispersion. So you have better and good companies in China under the same rating compared to the United States. And the other one is, what do you do if you have a company that might not be perfect, but that wants to have financing? And in China currently, that company cannot go through the bond market because you have to have a rating better of AA. Let me then just briefly talk a little bit about the government bond market. So the government bond market accounts to, and these are the CGBs, accounts for 20% of the whole market. As already indicated, they have the whole range of products from 3 to 50 years. But there are some unique phenomena. Who actually holds the bonds in China? The banks. 70% of the banks hold the government bonds. 70% of the bonds are held by banks. And that creates some problems because they usually keep them until maturity. Sally will discuss that later on. Because of that, there's very little liquidity in the secondary market, and that's not so good. Now, despite the fact that the liquidity is still limited, and it's concentrated on the short end of the yield curve, the analysis that we did suggests a few interesting things. You know that yield curves usually have information content about the economic performance in the future, economic activity, industrial production, or expectations about inflation. So it's usually a tool to get information about what the market thinks about the future. Now, despite the fact that the liquidity is more limited, it turns out that the yield curve increasingly has informational content, especially on the short term, in terms of expectations about economic activity, industrial production, and inflation. Second one is, when the central bank changes short-term interest rates, the infamous DR007, how is that being transmitted through the entire yield curve, and or does it even have an impact on the yield curve? And the answer is yes, there is a transmission from short-term to longer-term rates. That's also a very good sign. And I think which was quite surprising, at least for some of us, we already highlighted that China's financial system is not integrated with the world, correct? So what happens in the rest of the world, in terms of US monetary policy, for instance, shouldn't really have an impact on China, correct? But it turned out that's not the case, especially after the global financial crisis. Changes in monetary policy in the US, so monetary policy shocks from the US, do actually have an impact on the yield curve, and the same thing is true for volatility as measured by the VIX. So with that, I'll pass on the baton to Sally, who will then discuss credit bonds and other issues.
Thanks, Alfred. We're able, two economists and a technical person are able to get the speaker. Here we go. Good thing I have a day job. So I will now go through what we're seeing in the credit bond market and some of the unique characteristics that we're seeing in China's bond market. And this is fascinating. So earlier, Alfred talked about how the credit bond market in China is really unusual in two aspects. One is that credit ratings are skewed heavily towards AA and higher. And this is highly unusual compared to US, as you know. And the second unique characteristic with regards to credit bond market in China is how segmented it is and has been in terms of regulation, in terms of different parts of the market being regulated by different authorities. So what we want to do in this exercise is really look at how different shocks, as we call it, to the credit bond market are reflected in bond yields. Are they informative? Are they reflective of some of the concerns that investors have with regards to corporate bonds? So here we looked at two types of bonds. We looked at enterprise bonds and we looked at corporate bonds. And we looked at the impact of, say, leverage on bond yields, profitability on bond yields, and liquidity on bond yields. Several things jump out. This is interesting. So if you look at the bars, the blue bar are corporate bonds, red bars are enterprise bonds. Across the board, corporate bonds are more responsive to these kind of considerations. So if you look at, say, leverage ratio, for example, for every 1 percentage point increase in leverage, you will see bond yield for corporate bonds to go up by 3 basis points. That's actually significant. And for profitability, every 1 percentage point increase in profitability lowers corporate bonds bond yield by 2 basis points. Again, very notable. Then look at enterprise bonds. The impact is negligible. Why is that? Recall earlier what Alfred said about segmented regulation and the history of how all these corporate bonds, credit bonds came about. Enterprise bonds are issued mostly by LGFVs, local government financing vehicles, and they're tied to local governments. So the idea of having a government backstop, the idea of the perception, I should say, of implicit guarantees is seen precisely here. Regardless of your profitability or your leverage, you're not penalized or rewarded because at the end of the day, perhaps there's a floor to where your bonds should trade. Alfred and Mr. Kwok earlier talked about the impact of this kind of system on credit allocation. Well, this is one area where you can see this to the extent that you're not penalized for excessive leverage because you're tied to, say, a local government. You're perceived to have some sort of backstop. There's no market discipline for this. What about liquidity? This is interesting. Liquidity, for every percentage point increase in liquidity, so more liquidity doesn't necessarily narrow your bond spread, in contrast to, say, what we see elsewhere. And we think this probably has to do with the fact that, as Alfred also talked about earlier, a lot of these bonds are being held to maturity. So if you have shocks in the secondary market, it doesn't really affect you. So again, that affects the access to credit and the allocation of credit and resources. Let's talk about this a little bit more. So we talked about the idea of implicit guarantees. What we have here is really a chart of different bond spreads across time. So you see we have spreads relative to CGBs for central government SOEs, local government SOEs, and then non-SOEs. So these are essentially, you can think of them as almost like private entities. And you see that consistently, bonds issued by SOEs, and especially central government SOEs, their yield consistently fall below others. They consistently have an advantage in terms of their funding costs. And this is the case even after the implementation of the budget law in 2015. When we ran the analysis, controlling for everything, sector, size, what we found is that on average, that privilege accrued to this perceived guarantee, perceived backstop, amounts to roughly 100 basis points. 100 basis points. That's notable. So that's the credit bond market, something that's unique to some extent to China. I want to turn our attention to something else that's also quite unique about China, which is really the high correlation between bond trading in the cash market and trading in the repo market. Now, on your left-hand side, you see this chart with several things. The line here is basically bond prices. And you have 3 bars. These are essentially trading volume for CGBs, for corporate bonds, and then the green bar is for NCDs, which is something that actually has seen increased trading in recent years. We can talk a little bit more about that. But what's really interesting about this chart is the high correlation between bond prices and trading volume. So you see bond trading volume dipped in the second half of 2013, and then it dipped again, across the board towards the end of 2017. Around the same time, bond prices collapsed. This kind of high correlation between cash market and repo market, you see that to some extent elsewhere, in the US, for example, because a lot of these investments are financed in repo, but the degree of correlation is unusual. So that's one thing. We can talk a little bit more about why is that later. But what's also unique about this is the degree to which this is volatile. It changes by a large magnitude, but also that change is highly durable. It lasts for a long time. So to document that is that chart on your right-hand side. So literally what it documents is the interquartile range of monthly government trading and over the past 5 years. And on average, you're seeing that that range is about 80% of monthly trading volume. That's twice as big as the next EM, which is Brazil, and 8 times as big as the US. Again, highly volatile, highly persistent, and highly collinear with really repo. So what's going on here? So we looked into this relationship with the repo market a bit more. On this chart, you see a correlation, again, correlation of 92% between monthly repo trading volume and monthly trading volume in the cash market for CGB. 92% correlation. This is interesting. It suggests several things. If these two markets are highly linked, what that means is activities and prices of the cash bond is highly dependent on funding availability in the repo market. Second, most of these repos are 7-day repo, overnight or 7-day repo. That's short-term funding. Most of these bonds, average duration of CGB in China, CGB is 6 years. 6 years. For credit bonds, it's roughly 2 to 3 years. So even just 2 to 3 years, with 7-day funding, you're looking at tremendous mismatch in terms of your asset and liability maturity. So from a financial stability perspective, this is a concern. This suggests that actually, not only do we see close linkages between repo and cash, but shocks and volatility from the repo market can be amplified to the cash market. And that degree of impact perhaps is larger in China than elsewhere. So to hammer in that point is this chart on your right-hand side. It's a correlation between the cost of 1-month Shibor and average trading volume in bond cash market. And you see essentially that as prices go up, as funding costs go up, trading volume falls. Highly unusual. We don't see this anywhere else globally. So let me just move on. I should just advertise this. In the book, we talked in detail about why this is the case. What is it about the investor composition base in China that has led to this kind of high correlation between repo and cash trading? Just to preview a little bit, part of it is because there's a prevalence of carry trade activities. A lot of these are leveraged purchases, but also has to do with the lack of hedging instruments. But moving on, looking ahead, as Alfred said, what are we seeing so far with these index inclusion? Well, on this chart, you see that China has seen sizable inflows, both in terms of equity flows and debt inflows in recent years. Partly because there are quite a few events happening. There's the MSCI index inclusion in 2017 with equities, and of course, as of April 1st, there's a bond index inclusion, as Alfred mentioned. And as you see from the table to your right, essentially Bloomberg Barclays included these government bonds and policy bank bonds as the index, and it's highly likely that JP Morgan and Citi will consider and start including these bonds into their indices as well. So based on assets under management that are tracking these indices and the index weight, we're looking at, on average, across all the different estimates, probably around 120 billion of inflows into China. That's quite sizable. That's spanned over the entire phase-in period of when these bonds include, but it's quite sizable. But if you look at what foreigners have done when they enter the Chinese bond market, it's striking. First, you see size, compared to history, what foreigners now hold is represents a sizable increase in terms of bond inflows. But in terms of what they hold, as Alfred mentioned earlier, on average, still 2%, less than 2% is quite low. And if you look at the composition of what they hold are skewed towards what we call rates bonds. There are government bonds, that purple line, see that's almost 7%, and some policy bank bonds, which is a green bond. In terms of holdings of others, say these credit bonds, enterprise bonds, corporate bonds, it's negligible, nothing. Why is that? In part because, as Alfred said earlier, ratings are skewed. So it's not clear to you as an investor, can you trust that rating? Is it truly a AA? Is it a AAA? We're not sure. Also, if you recall earlier about credit spreads, can I look at the credit spread and am I certain that it correctly represents the risks underlying these bonds? There's a lot of uncertainty regards that. So investment into these non-government, non-policy bank bonds have been very limited. What are some of the other hurdles for foreign investment in the Chinese market? Well, there are a few. Alfred mentioned earlier there's this tax in terms of uncertainty related to tax treatment of investments. Those of you who follow the market know that recently the Chinese government introduced a 3-year exemption for some of these investments, but it's not clear how they are, how they're being treated. If a bond's if you invest in something before this exemption took place, do you still qualify? If your bond matured already, then does your investment still tax exempt? It's not clear. So there's what we call a low-hanging fruit in terms of what you could do with regards to tax treatments of these investments. Think through, what can you do? What's a harmonized treatment? So that's one. But two, if you look at the different investment programs for access to Chinese bonds, you can tell there's tremendous variation across different programs. I won't bore you with the details, you can look at them, but between QFII, RQFII, CIBM, and Bond Connect, it's not harmonized. It's not clear, the applications are different, the tax treatments are different, repatriation is not transferable, it's not fungible. It's not easy. The other concern is this chart here. Now, we talked about turnover. Alfred talked about earlier in terms of segmentation in the government bond market, partly because of the largest investors in the government bond market hold these bonds to maturity. There's very limited secondary trading. This is the US in terms of turnover. This is China. Why do we care as policymakers, as students of China's financial market and macroeconomy? Why do we care? We care because a liquid secondary market offers invaluable insights into investors and markets' expectation regarding the macro outlook, regarding inflation, regarding growth, and regarding risks in different segments of market. And it offers a valuable benchmark against all the other bonds, rates bonds, credit bonds in China from which they are priced. So if you have low confidence that this might not necessarily reflect what you see, you won't want to be in this market. So that's not a hurdle. Yet another hurdle, I feel like I'm being very negative right now, is the idea of hedging instruments. We talked a little bit earlier about how there's this high correlation between cash trading and repo trading. One of the problems is there's not sufficient instruments to hedge your position, your exposure. As a foreign investor, as an investor coming from offshore, onshore, one of your exposure is FX from US dollar to renminbi. How do I hedge that? Well, the problem is a lot of the global investment managers, the activities through them are tied to their custodian banks. And a lot of these custodian banks, for various reasons, either infrastructure, either personnel, human capital, they're not ready to really provide these kind of services. So what do investors have to do is come offshore in the CNH market. Well, as you know, the CNH market is liquidity here is not as steep, it's a smaller market, and it's highly volatile. So it's not ideal. So that's one. Two, you have to sign agreements. You know, for every counterpart you have that you want to access the onshore market, you need to sign ISDA, you need to sign agreement. These are cumbersome. And for every counterparty you have to sign an agreement. Imagine that. So that affects the willingness. Oh, did I just go back? Or did I go up? Oh, okay. So that affects the willingness to come from offshore to onshore. The other consideration is interest rate hedging. Again, you know, as a fixed income investor, you want to hedge your interest rate exposure if rates will go up or down against your expectations. Now, in theory, this market has been growing in China, and actually on paper, the fixed income, the suite of instruments available for interest rate hedging is wide. It actually covers a whole spectrum. But in reality, the take-up of that market has been fairly limited. And you see most of that, in fact, the different counterparties that actually use those are what we call the investment complex. You know, people tend to be more active, but that market, including treasury futures, are not open to foreign investors. So again, you know, if you're looking at this market, this tremendous market that offers diversification benefits, you can't really hedge your risk. You have some reservation. The Chinese authorities are aware of this. They've done quite a bit in recent months and recent years to address some of the concerns, and Alfred mentioned some of them, but certainly there's a community, you know, just to quickly summarize some of the recent reform efforts. There are efforts spearheaded by PBC to unify regulation. We talked about the tax exemption. We just need, you know, there needs to be some clarity, but nonetheless, there's a tax exemption out there. We talked, you probably know that the bond market now is open to foreign rating agencies. S&P recently got a license to be to operate onshore, and Fitch and Moody's have applied for their licenses. I think Alfred was too modest, but improved communication in terms of having an English language paper. One of the paper was done by Alfred and some collaborators, and that actually, we like to think that that was something that motivated some of these efforts. And of course, recent efforts to open up the financial market, including bond markets. The other thing they could do, and this is something that we have talked to them in recent years, is really the build up, not just hedging instruments as we talked about, but also the capacity to react to the complexity of this growing financial system. Blue bar is outstanding bonds. It has, as Alfred said, grown phenomenally in recent years. But the number of staff at central regulatory supervisory agencies, at these main agencies, have stayed stable and low by international standards. Stable staff, growing complex market. There's bound to be tension somewhere. So to wrap it up, what's our main takeaway? It's up here, but I'll summarize what I think are some of the things we'd like to highlight. You know, as Alfred said earlier, this next decade, perhaps we're seeing the beginning of China's financial market integration with the global economy. And it has tremendous benefits, tremendous implications for not just China, but the global economy. Mr. Kwok mentioned that earlier as well. So we're seeing the beginning today with the inclusion of the bond, inclusion of government bonds and policy bank bonds into the Bloomberg bond indices. To really fortify and support this process, there are a lot of things China needs to do. And it's not easy, but they're doing it. So, you know, if you look at the cover of our book, I like to think that there's a sun on the horizon. Certainly changes are afoot. And at this juncture for China's bond market, there can only be changes going forward. There can only be greater foreign participation, greater opening up, not just for China itself, but certainly to some extent also for the global community as well. So thank you very much, and then we'll take your questions. How should we do this? Oh, we have hot chairs. Here, I'll do this. Oh, so straight from. Turn this off. I'm off. Am I off? I'm not.
Okay, thank you very much. So again, my name is Tang. I'm the area head in the finance area at the Faculty of Business and Economics at Hong Kong U. So actually, when Casey contacted me about this, I had no hesitation. Right? I immediately said yes, and I actually also wanted to be part of it. When he asked me for a name, I volunteered actually to do this. I actually offered this class, credit risk, at Hong Kong U as well by myself. Before I joined Hong Kong U, actually Hong Kong U had no undergraduate credit risk class with all this credit bond. So I feel like this is really excellent opportunity, and I also feel like it's some kind of vindication that now the market really is real. Unlike when I was teaching students before, and I said, "What are you talking about? Right? There's no such a thing. Why do we need to study?" So I always told them that if you study now, you are going to have an advantage in the future when the market actually start to operating. And actually, this also happened when I was teaching risk management to equity mutual fund managers. And then 3 years ago, they were required to take exam. They are required to know value at risk, like VAR. I think going forward, more and more of these practitioners will be required to know a lot about this. They will need to have license. So I don't want to actually take too much time. And actually, no, we have to read the book. When I was listening to Alfred and Sally, actually, I had a lot of questions. I also had some answers as well. So I realized actually it's good to have this dialogue. So that actually, because I grew up in mainland China, and I also studied bond market. For example, when I was thinking about looking at these graphs, this figure you had that the corporate bonds are more responsive to, like their yields are more sensitive to leverage, for example, than the enterprise or government, like non-private entities. Then, of course, one idea is because they have different like guarantee system. Another is maybe the government entities, their accounting quality is lower, right? When they say our leverage is 10%, they could be 90%, right? So this accounting thing, accounting quality, and a lot of these issues may also need to be examined. So maybe I just take this privilege to ask a few questions first before we open up. I hope this will be okay to you. By the way, I'm really excited about this book in English because we have some Chinese books, and this is only the second English book after in 2007 when Gao Jian, right, the former vice governor of China Development Bank, had the first English book on China bond market. So after 12 years, we finally have another one, and this is also is important for foreign investors, right? They actually need to know. By the way, to our students, if you don't speak Chinese, it's also advantageous to actually learn Chinese because they don't have Chinese, English website until now, right? A lot of this, they only have Chinese versions, but they are also making a Chinese version for the book. So actually, my first question, because the context here is for foreign investors, is obviously about default, actual default, and the investor protection, right? Because this is like, especially the credit bonds, bond without default is not real, right? It's like Christianity without hell, right? No. And no one will actually behave well. So my question is, I also want to hear your thoughts on real investor protection. So what if there are actually economic downturns, companies start to underperform and they will be default. And even worse, the government policy may reverse, right? The policy may change. Overall, I agree with you that the direction is good, but in the short term, there can be fluctuations. Sometimes even will go backward. Right? So I want to hear you about your thoughts on investor protection.
Maybe two thoughts. We spend a lot of time in the book actually wanting to see more defaults. Because I think, think about China's economy, second largest in the world, with highly dynamic sectors. When you want to be at the cutting edge of whatever field you're in, it is always a gamble, correct? You might be right and you might be wrong. But there are no defaults in China. You can start out with bankruptcies. If you compare the number of bankruptcies in any given year, and you compare that to smaller countries like the UK, China has fewer. They're probably now at the magnitude of 7,500 defaults. Again, of an economy where you have 150,000 SOEs, and that does not include the private sector, correct? So that was just the bankruptcies. When you look at the bond defaults, up until recently, there were basically no defaults. Since the tightening on the financial sector regulation that started in 2017, we have seen a pickup in defaults. On average, bond defaults in China are 0.5%. Now, is that a lot or is it little? Well, if you compare that to the US, it's about 2%. So even though defaults have gone up, they're still relatively low, small number. However, if you separate between state-owned enterprises and the private sector, private sector defaults on bonds was 4%, so that's not negligible anymore. That of SOEs has been 0.1%. And that comes to the point that Sally was alluding to. If your system does not allocate credit appropriately, then that has implications for efficiency and ultimately for economic growth. So one would want to have defaults. Not that you want to wish anybody, but just part of that discovery process. But I think now comes the second point that you're alluding to. I think everybody would accept that there will be defaults, but it will also be clear that the rights of a bondholder, the covenants are specified clearly, and there is significant room for improvement. I think if you talk to people that have been in the process of sorting out after defaults whose right to get protected or not, it's not always so clear. So that needs to be strengthened as well. And then the third part is, and again, because you have basically lived in an economy where everything was insured. I think the only exception to the rule would be the equity market, where people have seen sharp fluctuations. But the rest of the economy, for all practical purposes, doesn't really see defaults. I should take that back. I think if you're a small business in China, it's very different. It's a very competitive market, and there are a lot of defaults. But if you are a large company, and it doesn't really matter at the end of the day if you're public or private, you probably have some implicit guarantees, and that's reflected in the spreads. Now, if you do have defaults, then also investors need to understand the risks. Currently, grandmothers manage to put all their money into a financial product, be it a wealth management product or a bond, or equity, because the assumption is you can't really lose anything. And that's a process that will take time. So when we started to think about how do you get away from these implicit guarantees, there is no textbook. From everything being insured to moving away from that, how do you do that in a way that is not disruptive, that does not lead to systemic risk Because when you default on a product, let's suppose a local government financing vehicle, we haven't seen any defaults yet. But let's suppose tomorrow there's a default. And suddenly everybody says, oh my gosh, there can actually be default. And everybody starts to reprice. And who is holding some of the debt? Well, again, it's the banks. And it spills over into the banking sector. So you can see how complicated that is. So it will ultimately be a trial and error, but it will be very critical. But if you have more defaults, which is not a bad sign, it's actually a good sign, then you will have more distinctions in the credit spreads between better performing companies and poorer companies. But then you also need to have better clarification of the rights of individual investors.
I guess you can also count your. So Sally, you would like to add anything?
See, there we go. Thank you. Sorry about that. I will just add one thing. You know, what's interesting is if you look at the, you know, we track the incidence of credit events in China. So this is not just defaults, but also essentially companies that are having problem making payments, basically an event. They're saying we might not be able to pay our principal back. It might be X number of days of credit event. And it has gone up. It has seen a sharp increase last year, and actually even into this year. It's on track to be, you know, as many, if not more, this year. But what's really interesting when this is happening is you're starting to see some widening in spreads across different credit bonds. Recall there's a chart I showed earlier how SOEs basically have this privilege. They essentially, they're able to finance. But for the credit bonds across different rating, AA, AA minus versus AA plus, there's now greater differentiation. So from our perspective, this is really a step forward and a very positive step in terms of credit differentiation. And it's really...
Yeah, definitely agree with you that actually the market does not completely believe in full guarantee that default can happen. Actually, more than 20 years ago, default happened from Guangdong, right? Mm-hmm. So actually, the default was resolved in Hong Kong, led by Wang Qishan, right? Actually in Hong Kong. So related to the issue of default is actually bankruptcy law. So as Alfred has shown us that the big sector now is local government bond. Actually, last year there was a near default in Xinjiang, right? Although eventually it was paid in full. But what worries me is actually in China, even though we have corporate bankruptcy law that was passed in 2006, there is no government bankruptcy law, right? There is no like Chapter 13 or like the bankruptcy procedure. There is no procedure for government entities to go through bankruptcy. So wonder whether you are thinking towards really nudging the government or even the law makers in China to really think about this. I saw news about personal bankruptcy, right? So China also doesn't have personal bankruptcy laws, but they are talking about it. But for government bankruptcy law, I don't see anything.
Let's start out with what is the government? So for instance, when we look at local government financing vehicles, this will be the first test, right? These are state-owned enterprises, and for them, the bankruptcy procedures would be relevant. So if the government actually were to allow them to default, you could go through the bankruptcy procedures because they're under the corporate law. Then I think you're talking, maybe, are you talking?
More like municipal bonds, right? This is
municipal
local bonds.
Yeah.
That is a little bit more complicated globally. We looked at this a little bit more carefully. You know, can local governments in other countries default? We know the US. The US happens to be almost the exception to the rule. In some other countries, we looked at Austria, for instance, it is not really clear legally whether a municipality can default or not. So when you look at the municipal market across countries, that is a little bit more tricky. In the Chinese context, if I understand correctly, some of you might know this better, local governments are not independent entities. They are not separate from the central government. There is no clear separation between the two of them. That would imply that having a default on local government bonds would probably be a little bit more tricky, I would think. And to assume that, you know, the structure, the government structure were to change, where suddenly you'd have local governments independent and they can default, that would of course be you know, a longer discussion.
So we can still assume that there's a implicit guarantee for the municipal bonds, right?
You know, the question is whether you can call them implicit guarantees or they're actually more explicit, right? Because if local governments are legally entity of the central government, correct? Then that separation is a little bit artificial. Yeah. Now, I'm not a lawyer, so it's probably better to talk to lawyers, but from the far distance as an economist, you know, maybe the term implicit guarantee is not even the right term. We know that local government financing vehicles, those are legally corporates, and they should not be protected by the local governments. But that's where, with the exception of two, we haven't seen any action. We saw I think you might have referred to that, a 3-day payment delay last year, which by some was considered to be the first sign of a default. Credit spreads went up, and within a few days, when the issue was resolved, credit spreads went down again. So for all practical purposes, maybe that was not a default, and then we had one in the offshore market. So that's the only thing that we've seen. But before you even get to the local government bond market, I think the first test will be whether, you know, there is a default on local government financing vehicles, because then there you don't have even that issue of is it part of government or not, because legally it's not.
Yeah, actually, definitely we can have this conversation all day, but let me take this opportunity to say that I have actually academic research paper on local government default, but it's bank loan default. So if you're interested, feel free to contact me. But we are here, we just talk about the municipal bonds. And there are many issues related. One is actually still, those bonds carry different yields, right? So they actually, the market doesn't take them as equal, right? As Sally just mentioned. So let me just open this for a few questions. Let me actually can you identify yourself and then keep your questions brief, and also so that we can have more questions. Right.
Well, first of all, thank you very much indeed for these interesting insights. By the way, my name is Andrew Leung. I'm a China strategist. Your presentation and also this discussion just now underline the very fact of the explicit and implicit hand of the state in China's bond market, in fact, in China's economy, both in kind of implicit kind of guarantee and then the easy access to capital. So that causes a lot of other sort of phenomena or the problems. In fact, this is the very thing that is highlighted in the current trade war with the United States, and indeed with the concerns expressed in European countries. So my question is that looking forward, the development of China's bond market, bearing in mind that China is unlikely to give up its state capitalism model anytime soon, to what extent will it affect the development of China's bond market, with the role of the state remaining relatively dominant, both in access of capital and indeed, particularly in the local governments, through the local governments of vehicles or whatnot. The other related issue is about the renminbi in terms of its globalization of this market. As you rightly pointed out in the beginning, there are more currencies in the world that move in tandem with the renminbi than with the US dollar, even though the US dollar is much stronger and more powerful That's highlighted by the Peterson Institute of International Economics some years back. But then the internationalization of the renminbi also depends on to what extent is the capital account of the renminbi is allowed to be fully, open. Again, this would impact on the globalization of the bond market because it depends on renminbi and so on and so forth. So on two fronts, one is the state, the role of the state in China's economy and particularly the capital market, and secondly, to what extent it would affect the long-term internationalization or the convertibility of the renminbi.
Thank you. So I do see actually the gentleman will be the second one, but can you just quickly respond?
You hit the nail on the head. Two answers. Having a dominant state doesn't necessarily mean there cannot be a part where the market decides the allocation of resources. And I think you will have seen the announcement more recently. There is a discussion about creating what is called competitive neutrality. In the end, it is kind of speaking to the same thing that all companies, whether they're public or private, should have access to the same resources at the same price, assuming everything else being equal. Now, the way you divide it up is that there is a part of the economy where the market mechanism does not operate, and you probably identify the sectors, and the sectors have been identified by the government. The key is that the ones that are being left over for the competitive part of the economy, that you create a level playing field for state-owned enterprises and others. In the European Union, for example, there's still a lot of state-owned enterprises, but there has been an effort over the last 20 years or so to ensure that they don't get artificial benefits. The second part was RMB internationalization. Now, when in the capital account, in all fairness, for the RMB bonds to be included in the index required that there is no capital account restriction, meaning for the bond investor, you can bring in the money and you can take it out. I think what you're alluding is to maybe the residents investing abroad, but that's still separate. So as long as China continues to allow foreign investors to come in through the Bond Connect and allows the bond investors, if they want to divest, to get out of the market, then that capital account liberalization has already taken place. Now, some argue that a further opening up of China's financial system, Ray is one of the economists that has highlighted that, it can be risky. And it is true, and the governor in a speech the other day actually spoke to that and said, further opening up carries risks and benefits, but we're confident we can manage the risk. From the point of view of the IMF, our advice is, as long as the further liberalization of the capital account and the opening up of the bond market now is associated with allowing the exchange rate to move more freely and to move toward a monetary policy framework where the interest rate becomes the main, short-term interest rate becomes the main target, that those risks can be managed. But again, they have to move in tandem.
I think indeed the Bond Connect is a really great scheme. A few weeks ago, actually, the Bond Connect transaction data was actually available in Bloomberg, so you can check it out. So do you have a mic over there?
Thank you.
Can you identify yourself, like the name?
is a little bit unfortunate. If you take the view that default, I think that may be an academic type of perception, but from a business and investment perspective, I'm there wanting to see investment protection. And until the government allows rating agencies to do it, and to provide independent, third-party financial assessments, until we see a governance environment improve, until we have more transparency of financial information, until we have information that's more accountable and transparent to us all, plus more simulation of IFRS and GAAP in terms of standards. I think I'm not a golf company. Maybe you're more old company, but I'm not as company as you are. In my background, I had a friend from Asia who made an investment there. I advised him and then waited, and I was here 20 years ago in jail in the Valley too. And we learned then about the ambiguity of whether or not there was going to be government support or not. And the answer is going to be given is that
Steve, really appreciate your views, and I guess this is about like hedging and the overall risk.
Yeah, if I could just come, because I think we want to be understood correctly, correct? We fully agree with you. As a matter of fact, why is it that people invest in China's government bond market? Because the information on the credit bond market is not adequate, correct? Or the other way around, when we argue, it is not that you wish for a default, obviously not. But when you have an economy that is dynamic, there are likely going to be defaults. That's just natural. But what you want, and that's the point that you're alluding to, is you want to have that reflected in credit spreads, correct? You have junk bonds in the US. If you invest in a junk bond, you know that the likelihood of the default is high.
You want to be paid for it.
But you want to be paid for it, correct? So what we're saying is exactly the point you're making is we don't believe that the credit spreads are helpful, including because the rating is probably not what it ought to be, transparency, corporate governance, all of these issues. But if you are moving to a world where you see credit spreads go up, where you have foreign rating agencies come in as is expected, that does provide different informations to investors. You know, if you're getting 15% on return on your bond because it's a very risky investment, then that's fine. So that's our argument that we're trying to make.
And I just want to add this. I think to the extent that you're seeing now with these credit events and these defaults, that there's greater differentiation in spreads, suggests not only that on the issuer side, perhaps there's hopefully more discipline, but on the investor side, there's greater investor discrimination against different types of credit, that the investor base, by and large, it's becoming more discerning and discriminating against different types of credit. And that, from our perspective, is necessary, and it's all to be welcome.
I think it's really good to have this conversation, but my suggestion here will be, actually there's also an active CDS market on about 25 to 30 names in China, especially China Development Bank, right? So China actually onshore is trying to actually also start a CDS market, credit for swap, and China called this CRMW. Yesterday actually they issued one bond with this CRMW embedded in the bond. So definitely Chinese government and also investors also are thinking about hedging instruments. So CDS is one thing, of course. CDS has its own problems, but let me just, we can definitely chat more. And since we have a big crowd here, I'd like to give everyone a chance. By the way, I probably also organize another event since I see a lot of interest for this China bond market. Do you have a mic?
Yeah, hi, Andrew Collier at Orient Capital Research. I have two questions. One is on your data on the correlation that was from early 2018. My understanding is that the PBOC has cut back on the use of the interbank market for a lot of stuff. So I wondered if that correlation still exists.
You can certainly update that, yeah.
And the second question is a broader question I think Steve was alluding to, which is that the point of the enterprise or the LGFE bond market is not to price risk, but it's essentially to provide financing for local governments. So you could argue that Beijing is indulging in regulatory arbitrage on a massive scale by implying implicit guarantees, even though, as we know, that's not in the actual guarantees. And the corollary to that is increasingly, the data I've seen for 2019 and 2018 is that private funds are the purchasers of a lot of bonds, which means essentially that Beijing is shifting the fiscal responsibility from the banks to private investors without making transparent the fact that this is in fact a government obligation. So the chances of reform are very unlikely unless they institute fiscal tax system that would provide another source of revenue. So I mean, the whole market is, to Steve's point, is really going to have a lot of issues.
Your point is very well taken. In all fairness, I think the government has, at least from the regulatory side, over the last year and a half, tried to make clear that local government financing vehicles don't have an implicit guarantee. As a matter of fact, they issued a regulation, I think it's about a year and a half ago, where they were holding local government officials accountable for life if they were to violate that rule. For example, in the good old days, 2 years ago, your local government's providing letter of comforts for some of these activities. That has all stopped. But I think the point that you're alluding to is a broader question, and that is, as long as local governments are not put on sound financial footing, you have spending obligations that are higher than your revenue intake, you have to get the resources from somewhere, correct? So in the end, it speaks to what we call a central federal realignment. That's difficult to do in any country. Now, there is a little bit of hope. The government has been talking about for a long time. It will not be a panacea, but the property tax it could be a first step in the right direction if and when implemented. Unfortunately, property is such an important part for China, as it's an asset class for all practical purposes, and the economy depends highly on. So implementing that tax, you make a wrong mistake or you make a mistake, has basic effects every single household in China. So people are a little reluctant, but that would be an important. But your point is very taken. It has nothing to do with the bond market. It has to do with the fiscal soundness of local governments.
So I understand actually the book mostly is useful for like foreign investors, but to also consider like the issue from the perspective of domestic investors. So recently, actually, one major thing happening in China is they allow households to buy government bonds, including the local government bond. And in the past was the T-bond, treasury bonds. Individuals were allowed to buy 10 days out of 1 month. Now it's basically 24/7. Right? They can always buy it. They're encouraged to buy the local government bond. That actually really alarmed me. I only saw this when I was like 7 or 8. That in my drawer, I saw this government bonds. But that was actually a way for individuals to actually support the country instead of really good financial investment opportunities. So I'd like to hear your thoughts about also the domestic, not so sophisticated investors, like especially households.
By the way, the book is not just written for foreigners. As a matter of fact, probably 80% is written for China, for Chinese policymakers, what needs to be done to make the market work, I think, to dealing with the issue that you highlighted. And a critical part is the household sector, not only the household sector, even the corporate sector, to understand risk. Because everything has been insured, with the exception of the equity market, correct? There is nobody who understands risk, and that implies, and we have seen it often, especially retail investors, you give them 200 basis points, not even 50 basis points, higher return, they take all of their savings from a deposit account and put it into the new product. Now, how do you break that? Now, of course, you can have campaigns of literacy and financial literacy. But in the end, I think, unfortunately, it's trial and error. you have to allow a certain number, you have to allow some volatility where people actually experience, you know, you can put all your money into a particular financial instrument, but there are also risks associated. So if you get 500 basis points more, then that is probably going to be more risky. So it will be a long process, and you can't rush this either, again, because if you do it too quickly, then the whole system shuts down, and then you can have, you know, spillovers into the financial sector.
I think I just want to add one thing. I think you brought up, you know, this is actually one point in terms of the broader challenge of China. How do you have a system to you know, how do you adjust the savings and investment imbalances, which to some extent still some lingering imbalances? How do you address the structural challenges in China in terms of the lack of investable assets to some extent still, and also, you know, related to the issue of domestic investors' demand for diversified assets. So that's one issue. But the other thing, just to add to Alfred's point, is with retail investors chasing higher yielding instruments, you see this in the P2P market. P2P markets, you know, really ballooned in recent years, and they offer really some pretty striking high yields. And of course, a lot of these P2P platforms were really questionable. So the government cracked down, and there were news headlines of basically people queuing up, demanding their deposit back to no avail, and the whole market shrunk, both in terms of number of platforms and asset under management, and also people's losses. But now we see some stability. So I think the point what Alfred's saying, and I want to echo that, is that there are going to be bumps, and perhaps big bumps. And it's part of the growing pain. And I think we do have to allow some of that to happen.
I take this as we should exercise a responsible lending, right? Instead of just wish for yield. So actually, it's one thing I learned from my good friend of mine recently, but he said in Chinese is 借钱的时候不做大爷，收钱的时候不做孙子, right? It's like when you make a loan, you don't pretend you are a big shot, right? Like you are the guru, right? Yeah. But then when you want to get your money back, you don't beg. Right? Yeah. So I think this is because in the past it actually happened. Going forward, we should be more professional, right? Quite understand the risk and return. I have a lot of questions. Time is running up. Probably, if you have the last question, then I can still allow it. Okay, good.
Well, first, thank you very much. I really appreciate your share. And maybe my question will be the shortest one, and it's a little bit out of topic. And I will ask about the U.S. bond market. And about 2 weeks ago, the yield curve of U.S. 10 years Treasury bond market goes down very sharply, and it even below the 3-year bond Treasury yield. And so, what do you think of the kind of this sign? Do you think it's a kind of sign of America's economic recession, or would it be expanded globally and even to China? And I'm a year one student from the Faculty of Business and Economics, and that's a little bit kind of a question.
Okay, then I guess we can just go quickly.
No, you know, we have the same. So I'm not an expert on the U.S. bond market. It took me 2 years to better understand the Chinese bond market. So, you know, we have some of the same questions. I don't know whether Sally has an answer to that, but you know, there are questions about what the yield curve tells us today, whether there have been changes compared to the past. But I haven't studied in detail, so I don't want to comment on that one. I don't know what you have some thoughts.
I think you're alluding to that historically the yield curve, the shape of the yield curve has very high predictive power in terms of growth. And certainly in the U.S. context, you know, the inverted yield curve has historically been associated with recession. In this case, I think the movement was so sharp, actually, and so dramatic that it actually calls into question whether something else is afoot. I don't have an answer, but I think from my contacts and colleagues who looked at this, perhaps there's some technical factors in there. Yes, there's a growth component, there's a growth forecast component, but perhaps in terms of liquidity, market liquidity, some of the algorithm behind some of these trading that's become increasingly prevalent, increasingly herd, sort of following with this herd-like mentality, there might be some of that as well.
Okay, thank you. I'm glad our students are interested. Actually, I want to mentioned to you the last graph Sari just put up. Actually, you should pay a lot more attention to it. Meaning, actually, there's a huge demand. There's a shortage of human capital, right? So the bond market grow a lot, but actually the professionals, especially from the government agency, right, they stay flat. That means actually we need to train a lot more students with bond knowledge. So with that, I'd like to thank Alfred and Sari for coming over and for this very informative and good sharing. So thank you, and now we finish. If you want to talk more to our guests, and if we're here, then we will be happy to chat more. Thank you. Have a good day.
Thank you.